thanks so much for taking time out of your day to be here with us. So I'm delighted to have Jeff Soh with us today. He's a partner at Liberty Corporate Finance, and he spent the last decade doing one thing really well, and that's advising management teams on equity plans. So Liberty specialise in guiding management teams through the full range of scenarios around this, designing new equity plans, reconfiguring existing ones, and advising during live transaction processes. So they sit in this space day in, day out. And I think for most FDs, most CFOs, a management equity plan is something you're going to encounter a handful of times in your career, often under pressure, often mid-deal. And Jeff has been in those rooms for a lot of those conversations. So today is a chance just to get a clear, practical view on how these plans actually work before you need it. So Jeff, over to you.
Hey, Charles. Thank you. Thank you, everyone, for making the time throughout your day to sort of attend this session. Charles, thank you for the kind intro. I'm going to hire you for my hype guy in future. So today we've got a short presentation just on private equity incentive plans. I'll give a quick introduction to Liberty and what we actually do, which will help give you some context as to how we sort of approach equity plans and what to think about pre-transaction, during a transaction, and also post-transaction. So if I bring my presentation up, and Charles, if you could just give me a nod to say that you can see that all okay.
Yeah, looks all good. Not on. Yeah, there we go. Full screen. And but what I should mention actually, what we'll do, everyone watching, is if you post your questions in the Q&A, and at the end, just to keep kind of momentum going, I'll read those out and give a chance for Jeff to answer those questions. But yeah, Jeff can see it all good.
Thank you. So a quick intro to Liberty. So we're independent corporate finance advisors to management teams. Usually where we specialise is around equity plans, and typically that arises where there's a change of control scenario. So oftentimes we're advising management teams on a transaction. So that's the context behind where a lot of this data comes from and where we get involved with equity plans. We also get involved pure and simple designing equity plans for corporates as well. But most of our experience comes from transaction scenarios, especially with private equity schemes. So the reason why independence is important is because usually on a transaction, you've got a sell-side advisor looking to maximize price and deliverability, but management have a unique position in that sort of role because they're often being asked to reinvest their money. And where you're being asked to reinvest, you should really have a right, and that's the reason why we exist as Liberty, to take advice and actually understand what are you reinvesting, how much are you reinvesting, and also what are you reinvesting into, what does the upside look like, as well as what do your protections look like. So that's why we exist. So there's a divergence of interest throughout a transaction process, you'll find, because the sell side advisors are looking to just maximize price and deliverability, but actually they don't really pay too much attention as to what your go forward equity plan might look like, and that's where we come in. In terms of number of deals, so we advise on 50 to 60 deals a year, which is roughly one deal a week. Why is that important? Is because we see a lot of different equity plans. So if you imagine each one of those deals, we might see 2 to 3 MEP equity term sheets from bidders, and that means that we see a lot of equity plans, and we capture all that data, some of which I'll bring up in the presentation today, just so that you've got a sense of what to expect when it comes to rollover and sweet equity discussions. We also have offices in London, Munich, Madrid, Stockholm, and Sydney. So that's Liberty in a nutshell. If I jump to the next slide, look, this is a slide full of deals. So this is evidencing the sort of 50, 60 deals that we do. Some of the household names you might recognise, like Marshall Amps, for example, deal out in Stockholm that we did last year. My Dentist, large dentistry business. For those of you who've got pets, you might recognise MPM, a large pet food business. So jumping straight to the next slide, and again, to sort of frame the concept of an equity plan, I suppose the key thing here and what we're looking to achieve is to achieve alignment of interests, right, with regards to shared goals with the private equity house. So usually private equity there to invest in businesses, and they're looking to make a return in, let's say, 5 years' time. And usually that's something along the lines of 2.5 times invested capital or 3 times invested capital. So it's important that you as a management team are aligned to the same exit and the same goals as them. So that's very important to PE houses, and that's why these equity schemes exist. The other key point around that is they exist because they're there to sort of attract the right talent, retain the right talent, as well as incentivize the right talent. So, to have the right sized and the right nature of equity scheme is very important for the delivery of a sort of investment plan or a business plan over the next 5 years to reach a successful exit, which is what everyone wants to do. And then the other component to that is having skin in the game, for example. So again, PE houses, they don't run the day-to-day business. They recognize that they're passive investors beyond sitting on the board, but it's up to the management team to deliver the business plan that they've put forward. And that's why PE houses are keen to incentivize the management team to have them reinvest and have skin in the game, so that you're motivated to achieve a successful exit. And then the final component towards the bottom, which is one of the same theme, is just to make sure that the equity schemes, the reason why these exist, because otherwise it would just be a sort of bonus environment, is that these equity schemes are designed to be not only sort of align incentives, attract and retain the right talent, for you to have skin in the game. It's also to ensure that they're tax efficient and they're subject to capital gains tax rather than income tax. So touching on the first sort of key theme around pre-transaction consideration. So, some of you joining the call, you may be part of an existing equity plan. You may also not have an existing equity plan. So there are various different considerations around that prior to a transaction. So, for example, if you do have an equity plan in place, one of the key things that we always encourage management teams to do is look at, do you have any unallocated shares or any unallocated sweet equity shares? Now, the reason why that's important is because you want to make sure you allocate that a long time prior to a future exit to make sure that you can allocate it and ultimately it is deemed a share and subject to capital gains tax. If you do allocate it too late in the day or it's too close to the exit or transaction, then ultimately that value can be delivered to whoever you want to incentivize, but usually that will be subject to income tax. So if you've got anything unallocated, you should have a think about it in terms of, should you be allocating those out to existing shareholders or new participants to the scheme, just so that you're not losing any tax leakage. What the management processes look like. So the other thing is a little bit of pre-education prior to a transaction to make sure individuals are aware of what is expected of them during a transaction process. So it may be the first time you're part of an equity plan, and actually, what are the expectations of you if you're going into a process, and is there going to be a reinvestment expectation? What does that look like? What will you be reinvested into next time round? And having that full story to hand is helpful because it kind of sets a scene for anyone who's being asked to reinvest during the process. The last thing you want to happen is that to be a surprise, and actually at the sort of 11th hour of a deal, someone says no, or I'm not quite sure what's happening, don't understand, not willing to sign. So the more sort of educated everyone is and up to speed everyone is, the better. And then the other last bullet point there is any issues with your current equity plan. So that's another thing that we try to flush out quite early, is actually you should have a think about your existing equity plan and what are the pain points along that journey, because no equity plan is perfect until you've sort of been through that journey. So common themes here might be, you might have issues with lever provisions, for example. So if you've had people be able to retain the equity, that might be something that wasn't particularly palatable to the senior exec team, of having levers retain equity, for example. The other sort of things to think about here are, whether actually the equity plan that you have already in place is driving the right incentives. You may have a ratchet in there, for example, or some sort of performance metric which it is or is not being hit. So things to think about there ahead of a transaction process. For those of you who don't have an equity plan in place, firstly, I suppose you should think whether actually the business is well suited to have an equity plan in place, and that's something that you'd like to look into. But otherwise, if you are going to a transaction process and you're being acquired, who are you being acquired by? What does that transaction look like? Is it private equity, for example, and therefore is there a reinvestment requirement expected of you? In that scenario, there's probably a discussion around how do you get proceeds to the management team in order for you to have some sort of reinvestment. Now, that may come in the form of an exit bonus consideration that you might want to discuss with your existing shareholder. But otherwise, you can also talk to various different loan structures that can be put in place from the buy side at the time. So if you don't have the benefit of proceeds to reinvest or exit bonus considerations, then you may be in discussions with having a loan mechanic in place with a buyer to help you buy into equity going forward. And then all the other sort of components of who should be investing going forward, who is the team now, who is the team going to look like next time round over the next 5 years, because that is where you most likely consider allocating the equity going forward. Now, just before we sort of dive into some stats and everything, a quick overview. So I've talked to sort of private equity incentive schemes. Some of you may be familiar, some of you may not be familiar. But here, what I've set out is 2 bar charts. One on the left-hand side is on entry, so at the investment point, and then you've got a theoretical exit scenario to the right-hand side, signaling sort of a 3 to 5 year exit and what the growth across the various different instruments might look like. So on entry, private equity would normally buy the business with some sort of third-party bank debt. So that's a blue bar there. And most of their capital, most of the equity funding from themselves, as well as management's equity funding, i.e. your rollover reinvested proceeds, would go into a combination of ordinary shares and fixed return instruments. Now, fixed return instruments might be preference shares or loan notes. Either or, the fixed return instruments will usually have a fixed interest return, hence fixed return instruments, right? So that might look like a 10% interest rate that compounds over time. So you'll see that the fixed return instruments from left to right, you'll see that grow by a fixed amount. So if it's 10% over 5 years, it's going to be 1.6 times, right, in terms of the growth factor on your fixed return instruments. On entry, so most of their capital is invested in fixed return instruments, some of it's invested in ordinary shares. Now, ordinary shares are differentiated between different share classes. Usually that will be A shares for the investor class of shares, B shares for the management investment class of shares, and then you've got C shares for, let's say, sweet equity shares. And that, in theory, on a future exit, that all grows as the business grows. And then once you've paid off the third-party bank debt to the right-hand side, you've paid off the fixed return instruments, which is the sort of compounded fixed return aspect. Anything over and above that flows to the ordinary shareholders, to which the idea there is that you will be part of the ordinary shares and the fixed return instruments. So if you have reinvested, normally you'll be co-invested alongside the investor in what we call institutional strip. That institutional strip is a combination of institutional equity and the fixed return instruments. So you'll be invested in the same proportion of instruments as the investor there. So therefore, if the investor is looking to make 3 times return, for example, in 5 years' time, you would also make 3 times return on your invested capital there as well. Now that comes back to the perfect alignment of interest point that I mentioned earlier. So that's a critical fundamental part of any sort of MEP scheme. Now, in recognizing that the passive investor, the PE investor, they're passive investors and they're not there day-to-day running the business and delivering the plan, that is where management team have a carve-out of equity dedicated to them only. And this is what we call sweet equity. And the sweet equity gives you the additional equity upside over and above what the investor has in their institutional strip / what any manager investing as in terms of the institutional strip. So the sweet equity effectively juices up your returns because it gives you additional equity upside. And that's pretty key. And that's where management would make more than 3 times return in that scenario, in that example, because you've got the sweet equity kicker over and above the institutional strip, which is the co-investment piece alongside the investor. So that's a quick run through of the PE sort of capital structure and how a typical PE equity scheme would work. On an exit, how do you realize your return? So usually this is going to be some sort of valuation multiple based on EBITDA of the business. So that determines your enterprise value. Businesses are sold typically on a debt-free, cash-free basis. So you adjust for debt and cash in the business. And that is what would give you your shareholder value in line 4 to the right-hand side in the graph. So that's the shareholder value. Now, the important thing here is that fixed return instruments is ranking ahead of the ordinary shares. So in line 5, you'll see the fixed return instruments get paid off first. And if you have invested, you also take part in the fixed return instrument. So you get your priority return here alongside the investor. And then the ordinary shares, anything over and above repayment of the fixed return instruments goes to the ordinary shares, which again, you will take part in because you will have institutional equity as well as sweet equity. So that's line 6 there, where you see the sweet equity participants as well as the institutional equity participating as well. So that's how the sort of what we call the proceeds waterfall works in terms of the order of payments. You need to pay for your cash and debt, gets adjusted out. Fixed return instruments get paid next, and then the balance goes to the ordinary shareholders, to which the sweet equity and the institutional equity shareholders take part. Who should be part of the equity plan? So this is very much personal to each and every management team and business out there. So it very much depends, and it's one of the things that we sit down and speak to management teams about. Usually, what we see most commonly is that the equity is spread across the senior management team, which means the C-suite team. Now, that's the way we tend to guide management teams, is that the equity should sit with the people who are driving the business plan and driving the equity growth, right? And it's important that whoever's doing that understands what they're holding, understands the power of the sort of the sweet equity that they're holding. Now, if you're, just for sake of, to play devil's advocate, if you're allocating to a sort of junior, let's say graduate or the most junior entry point to the company, now the question is, will they understand, an equity sort of share that they hold? Will they be there, long enough to sort of realise the growth in that equity through to an exit, for example? So usually it's contained for the senior management team. Now, we speak to some management teams and they like to allocate out to the next tier down. So let's say the next 20 or so managers, because the nature of the business requires a lot of, let's say, a big sales force, right? So you might have a bunch of sales individuals sitting there who need to be incentivized for the business to grow. So that might be reason for you to extend the equity further down. And then we have some businesses which are very people focused. For example, we've advised a bunch of different accounting businesses, different wealth management practices, where actually everyone is involved in driving revenue, and therefore they want everyone to be involved in the equity scheme. So that's where a much wider scheme comes into play. So we've advised businesses which have 400 plus employees, all part of the equity scheme. The key things to consider when it comes to sort of negotiating what the equity package looks like. So ultimately, this boils down to 3 things, and this is not the 3 things up on screen. The way I think about it, or most management teams think about it, is actually, what's it going to cost me, right? What's my upside, and what are my protections? Those are the 3 core questions that we come up time and time again. And ultimately, when we kind of transcribe that into these components. So what's it going to cost me generally comes down to what is the rollover percentage look like? What do I need to reinvest? How much do I need to reinvest? What's my upside is usually around can we maximize the size of the sweet equity pot for the management team? Are there any ratchets or additional equity for performance reasons, etc.? And then what are my protections come down to the wider terms around the equity scheme. So, for example, leaver provisions. What happens if I leave the business? What happens to the sweet equity? What happens to the institutional strip? What are the governance arrangements with my new majority shareholder? What are the consent rights? So on and so forth. And then you've also got this overarching component of how can we make this as tax efficient as possible, right? In terms of us reinvesting, do we need to pay tax on all the proceeds that we get out? Or do we need to just pay tax on the cash consideration, i.e. we can defer the tax on what we roll over, which is often possible. And then the next few slides that I'll bring up, I've got some statistics around sort of what we capture around rollover as well as sweet equity, some data around sort of ratchets, for example. So I'll just go through those to give you a sense of what to expect. So rollover, I think the key thing here that we come up time and time again is we fight for a net rolling over net of tax and costs, right? So when PE often talk to management teams, they try to push them towards rolling based on a gross basis, right? Gross of tax basis. So, we fight hard for management teams to say, look, it needs to be net of tax and costs because ultimately that's money that they're never going to see. So we need to factor that into the calculation. And when we talk to what's common around rollover percentages, 40 to 50% is probably the most common that we see. Most PE houses will start with 50%. Some PE houses might be pretty aggressive and ask you to roll over 60%, but you can be sure that 50% is probably the market position. And then sometimes we can achieve 40 to 50%. Anything below that, you probably need a very strong narrative around. For example, if there's a retirement story, all of that we will kind of talk you through prior to a transaction to make sure that we've got the narrative set and who's rolling what percentage and what your expectations are. You'll see on the graph to the right-hand side, people rolling more than 50%. Usually that's going to be on an entirely voluntary basis. If you're very bullish about and you don't need the cash today, then volunteering more than 50% rollover, that's going to be music to any PE investors' ears. And again, I've mentioned tax deferral. So again, we'll try to always achieve tax deferral where we can because it means that you only pay tax on the cash out component, which allows you to minimize your tax bill this time round, which allows you to roll over a bit more as well as cash out a little bit more. I've mentioned already, if you don't have any proceeds to roll over, then that's one to consider, right? And oftentimes when we do get appointed early in the process, we often sort of have a conversation with the existing shareholder to talk to exit bonuses and actually set expectations around actually, given the nature of the process, there is going to be reinvestment involved, and therefore it's prudent to actually provide something in the form of an exit bonus to allow management teams to reinvest something. In terms of equity plans, so sweet equity, 15 to 20%, based on data to the right-hand side, is usually the hotspot for where sweet equity sits. In terms of the fixed return instruments that I've mentioned, so the loan notes or preference shares, 8 to 12% is probably the common ground there. 10% is what we see the most. Maybe 2-3 years ago, when interest rates were sort of sky high, that kind of stretched up towards 12%, but 10% is certainly the norm at the moment. And then the other component that I've talked to is this concept of a ratchet. So the ratchet is just additional equity, so additional sweet equity for hitting certain performance metrics. usually those performance metrics are entirely tied to what the investor is making from a return standpoint. So if you make a certain return for the investor, which you won't know until you come to an exit, right? Whether that's a multiple of invested capital, MOIC, or multiple of money, same thing, or an IRR threshold. If you hit certain return thresholds for the investor, then they can provide additional equity upside for you. So in the examples, the right-hand side, you'll see a sort of double ratchet. So there's 2 performance hurdles whereby you get additional equity for hitting those. And then there's probably worth mentioning that there's 2 different forms of ratchets here, which is quite common in the UK market. One is an excess ratchet, whereby if you hit that performance threshold, you take part in the equity above that threshold only, right? Which you can see by the sort of shaded box to the top right-hand side. Now, the alternative to this is what we call a total equity ratchet, or also known as a sort of catch-up ratchet, whereby if you hit that certain performance threshold, then the next round above that performance threshold goes to the management team, and until you catch up to your position, whereby you get the full percentage of all the ordinary shares, which is obviously more lucrative than an excess ratchet. So if you ever face that, it's worth asking the question, is this an excess ratchet, and worth fighting for the fact that this should be a total equity ratchet or a catch-up ratchet. Next slide is on sort of your protection. So this is one example of many protections, but it's probably the one that's most emotive to management teams, and most relevant, that they'll probably see along the journey, whether it's something that they are enacting, right, because you've got levers within the team, or whether this is happening to you as the lever yourself. So here, the key thing here, I won't go through all the detail, but it's to make sure that this works for the business, right? So this needs to be a firm but fair position, because you as shareholders collectively, by virtue of you having institutional strip as well as sweet equity, you need to consider with your shareholder hat on, as well as you with your lever hat on, right? So you've got 2 hats that you wear here as a shareholder, as well as potentially being a lever. So therefore, this generally shakes out to be a firm but fair position, because you need to protect the nature of the business, you need to protect your shareholding in the business, and where that has generally ended up with lots of legal advice along the many years, or the past 10 years I've been here at Liberty, it's kind of shaken out to be 4 categories: good lever, intermediate lever, bad lever, very bad lever. Generally speaking, good lever will be things outside of your control. And one thing that we do fight for, to the right-hand side, you'll see that sort of grey set of boxes, is that your institutional strip, which is your rolled investment, right, your reinvested investment, co-invested alongside the investor, that we try to fight quite hard that sits outside of the provisions, because it's capital that you've personally invested through proceeds that, in theory, you've earned from the last deal, for example. We try to keep that outside of lever provisions, except for very bad lever, which we'll come on to. So therefore, for the most part, if we get, let's say, the Liberty way, the lever provisions mainly pertain to the sweet equity component. So good lever, things outside of your control. Very bad lever tends to be things that you are doing, or the lever is doing, which is certainly within their control, because they are either breaching their restricted covenants, such as competing against the business, soliciting staff, etc., or committing fraud, right? All of which is active knowledge for that individual committing that breach. There, your institutional strip, there's good arguments for that to be impacted. Now, the question is, how harshly is that impacted? Our sort of more management-friendly version of that is that value just gets frozen at that point in time, so there's no further upside, and you only get liquidity come a future exit when the business sells and the PE make their return, then everyone else makes their return. And then sweet equity, you get the low of cost and fair value back, which generally is going to be quite low because, assuming the business doesn't go backwards, you get your costs back, what you paid for your instruments. Now, bad leaver is someone who chooses to voluntarily resign. So if you choose to step off the bus, step off the pitch, as well as committing gross misconduct or doing other sort of naughty things, right? So there, again, your sweet equity is bought back at cost, assuming the business doesn't go backwards, and then strip, generally speaking, outside of legal provisions. Now, some PE houses may want your strip to be impacted in that scenario. And then finally, intermediate lever is catch-all definition, not good, not bad, not very bad. The most common scenario here is that you're being asked to leave, right? Generally for performance reasons, your face doesn't fit reasons. And there, again, your strip is outside, but then you're subject to a vesting schedule, which is time-based. And that may look like something like 0 to 100% over 4 years, 0 to 100% over 5 years, for example. But the point is that the vested sweet equity gets fair value, and then the unvested sweet equity gets lower of cost and fair value. So that's a sort of very quick overview of lever provisions and the general construct that you'll come to face. These will get negotiated quite heavily, right? And it's important to spend some time to think about this because this needs to work for the business. Key documents I won't spend too much time on. So you've got your SPA, right? You're in the middle there. You've got your share purchase agreement, which is the main contractual document governing the sale. Everything that I've talked to around the sort of equity terms and the equity scheme, usually we would go out with an equity term sheet, which captures all of that. Now, our sort of approach is to have that quite detailed because what often happens is, given the pace of a transaction, you tend to sign the equity term sheet with an equity wrapper, right, which is just an agreement to agree what's in the equity term sheet and convert it into long-form legal documentation between exchange and completion. And those long-form documents will take the form of the shareholders' agreement, bottom left, and the articles of association, which is the top right. So those are the key documents from an equity standpoint: is the equity term sheet, shareholders' agreement, as well as your articles of association. And then finally, things post-transaction to consider, and this kind of extends to the various support that will provide management teams beyond a transaction, and that might look like, firstly, if you don't have an equity scheme in place, it might look like a new management equity plan for the senior team. It might look like a junior management equity plan if a few years into a transaction process, you realize you need to incentivize the junior members of the team. The other key component here is annual updates. So we've spent all this time during a transaction to establish a lucrative and a competitive equity package. It's important that everyone understands what that means for them, because only then do you have the incentivizing effect of an equity plan. And then our clients like to come back to us and do annual updates, for example, which is almost like a shareholders meeting, if you like, for the management team to update them on share performance to date, as well as based on a revised business plan, what does shareholder sort of proceeds look like in terms of the forecast tomorrow. That's quite powerful. And then the other components are around anything that impacts your shareholding. So, for example, if you do a lot of M&A, there might be a dilutive impact. You might have a lot of joiners or leavers throughout the investment hold period. Again, it's something that we can help support on because we can update and clean up the cap table. And then finally, recut. So if these equity plans do not go to plan, which some of them, unfortunately, they don't go to plan. For example, post-COVID, we had a bunch of travel businesses unfortunately come back to us, right, because their equity was all underwater, and they were in discussions with their shareholders as well as banks around how do they re-incentivize, re-energize the business because they're in recut discussions around the equity plan. So that's pretty much it in terms of pre-transaction sort of considerations, considerations during a transaction process, all the key components around reinvestment, sweet equity ratchets, and protections, and then post-transaction considerations around shareholder meetings, updates, communications, as well as recuts if what was put in place originally wasn't fit for purpose. So I'll stop there and hand back to Charles and maybe pick up any questions.
Amazing. Thanks, Jeff. And I think the actual market metrics are genuinely hard to find anywhere else. That's not stuff you can just simply Google. I think the fact that sweet equity in that kind of 100 to 500 EV range is averaging around 70.5%, and most still sitting between 15 and 20%, that's a really useful number to have for people to have in the head for any conversations with PE investors. But we do indeed have some questions. So I'm just going to fire them out. Jeff, these questions came in as you were speaking, so potentially there might have been a slide about it, but we'll just hit them anyway. One from John here. Can the sweet equity be given to management team for no consideration or low consideration, and any tax implications for individuals or companies?
Good question. So yes, by their very design, when you first set them up, where I showed you the bar charts, most of the equity cap funding goes into fixed return instruments. The ordinary shares are thinly capitalized, so they, by its very nature, very cheap. And the sweet equity is a small proportion of that. So again, in an ideal world, certainly in the UK, you can sort of design that to be very, very cheap. So £1 million for the ordinary shares. And if it's a 20% sweet pot, so £200,000 for 100% of the sweet equity pot, and then you'll take your share of that. So yes, by their design, very cheap. You can do additional things to sort of help that situation. So, for example, you can provide loans in the UK, depending on the tax structure of the deal. But in the UK, you can provide loans for individuals. So if you've got an individual needing to fund 10K for their sweet equity participation, you can provide a 10K loan. The alternative to that is that you can loan them their tax bill. So, you could give the shares for free. There's a benefit in kind to the individual, and then you loan them for the tax bill that they face, which will reduce the loan amount that you are loaning to them. So it reduces the burden for the company.
Excellent. Thanks, Jeff. There's a question here. I might need your help kind of adding the context behind it, but someone says they presume this is with the mid/large cap in mind. What about the small micro cap?
So yeah, small micro cap we're less involved in. We certainly we tend to, most of our clients sit within the sort of, I'd say at the lower end, 30 million EV enterprise value through to sort of over $1 billion. So I've just closed that one with 4 billion. So that's tend to be where we advise. I wouldn't be able to speak to sort of micro cap, unfortunately.
Understood. And there's a question here. Do you also advise management teams on equity plans before the first PE deal and rollover?
Yeah, absolutely. So this is, different businesses, very different sizes. Again, we've got, on the cusp of microcap, but also, large £1 billion businesses who, founder owned, and they don't have an equity scheme in place. They've heard about these equity schemes. They've got a refresh of a new management team who are quite keen for an equity plan or the equity to be shared from founders as the business evolves and transitions. Obviously, you need the buy-in for whoever your majority shareholder there is of them. So you need their blessing to sort of engage on taking advice around an equity plan. But certainly that is something that we do come in to do, to establish an equity plan. And then hopefully there's a future exit on the horizon. And then that pays that in the same fashion as a PE equity plan. And then you move into sort of PE land from there.
Excellent. Okay. And another one here, what is the tax treatment on a lever scenario?
Yes, so not a tax advisor, so I'll caveat that. But it depends where you get liquidity for your instrument. So, for example, if depends on the nature of the lever provisions, but in the example of the lever provisions that I shared, so if you were resigning, for example, sweet equity, you get the lower cost and fair value back. So no tax there because you're effectively getting your costs back there, assuming business hasn't gone backwards. Your strip is outside the lever provision. So again, no tax at the point of you becoming a lever because your strip investment remains in the business and you would only get taxed on that come a future exit, i.e. when the PE chooses to exit the business. So at no point do you face a dry tax bill. Now, or the scenario where you may face a dry tax charge there is if there is a clause stipulating that you can get paid out as a lever using a different instrument, i.e. you get paid out via a loan note, for example, that remains in the business. That's where you might have tax complications where actually, HMRC deem that as crystallizing value into loan notes. You may get faced with a tax bill there and you're at risk of having a dry tax charge. Now, firstly, it's something that we foresee, right, in that scenario, if that clause is stipulated, and we try to fight for additional clauses to say that you will get paid out sufficient proceeds to cover your tax bill if you do end up with a dry tax charge.
Understood. Very good. Thanks, Jeff. And there's one here. Any market info on percentage of MIP that exec members should expect? For example, a CEO at 33%. But I'd imagine that's nuanced.
No. So absolutely. So it's market data that we do have. You can give me a call and I can tell you the detail. No, we do capture that detail. Our data there is probably stronger around the CEO and CFO, less strong around other roles, largely because we are sector agnostic. And I don't know, a CTO in an industrial business is not going to be the same as a CTO in a techie-based business, right? So the two constants in all transactions in all businesses are CEO and CFO, and we have good metrics there in terms of capturing what that looks like. But to throw out some statistics out there, 20 to 30% is probably quite normal for CEO. For CFO, it might be 30 to 50% of what the CEO gets.
Understood. Perfect. Thank you, Jeff. I think that's the lion's share of the questions. I can see some that are quite nuanced, and I can see some that even would probably be directed at me in my seat as recruiting CFO candidate. So we will send correspondence for me to answer any questions I can, and certainly to introduce you to Jeff. But yeah, I would like to absolutely thank Jeff. Thanks so much for that. Some brilliant stuff in there. And thanks so much for everyone attending. And we hope to see you on the next one.